This morning, markets are reacting to the US airstrike on the Syrian airbase that launched the chemical weapons strike early in the week. The FTSE is actually up this morning, but we're seeing that typical safe haven trade. So we're seeing yen up, gold up. We're also seeing a move into US Treasuries. So those prices are up, and the yield on US Treasuries are down. In terms of the economic news more generally this week, we've seen some good numbers. We've seen some good ADP numbers ahead of the non-farm payroll number in the US. We've also seen a strong Eurozone PMI, so we're at 70-month highs in the Eurozone in terms of business activity. In terms of commentary, though, the Fed have got more hawkish in terms of starting to reduce the balance sheet, taking some liquidity out of markets, and that's really affected markets this week. And the ECB have actually got more dovish, so they feel that the market has misinterpreted the last meeting's comments and that they're still a long way off that 2% inflation target, so we'll need to remain very accommodative. In terms of the UK, we're seeing a more conciliatory tone with the EU in terms of the Brexit negotiations, and we're seeing, following the presidential debate in France, Macron extend his leads in the polls, which is good for markets. So just looking at the sector performance this week, energy has led, and that's understandable given what's going on in terms of geopolitical risk. But we've also seen good performance from utility and real estate, and that's because of that yield curve rolling over to some extent, particularly in Eurozone, where we've seen good performance from our German residential property stocks, and equally the real estate stocks in the UK, which are very much centred around Brexit as well as that yield curve move. In terms of currency, as you'd expect, the only real winner this week has been the Japanese yen, and that's a movement towards that safe haven trade. In terms of corporate news flow, we've seen three pieces of raised guidance that of particular interest this week. Firstly, BTG, they came in with revenue guidance, upper end of their forecast. So that looks really good value on 19 times earnings if you look at those growth rates through 18, 19 and 20. Equally, Unilever came out with their strategy review where they're targeting a 20% EBITDA margin for 2020. You can see here from all the other FMCG businesses the logic behind the Kraft Heinz deal, with Unilever lagging in terms of that EBITDA margin. They've obviously had to accelerate the progression towards 20% in order to keep that acquisitive pressure away. The third area has been Xylem. They've raised guidance in terms of revenue, margins, and therefore EPS growth. We feel this is a really interesting business because it addresses what is a really important topic, which is water scarcity. And water consumption is growing at double the population rate. So urbanization, changing diet is accelerating or exacerbating the problem with water. So you've got 663 million people without access to clean water. And by 2030, demand is going to outstrip supply by around 40%. So we find Xylem, which provides smart infrastructure technology and solutions to address water provision and wastage, a very interesting business growing at mid-teens in terms of EPS by 2020 and trading on 22 times earnings. Looking at the week ahead, of most interest, we've got Tesco's on Wednesday, and then the US reporting season really kicks off on Thursday when we've got the banks with Wells Fargo, Citi and JP Morgan being of key interest there. Looking at Wells Fargo, we're going to be interested in whether the deterioration in their account openings is continuing to accelerate. Here we've got the year-on-year falls on a monthly basis of their consumer checking accounts. As you can see, the acceleration there, and also in the credit card business, which is decelerating at a faster rate. In terms of Citigroup, while we like the banks for lots of reasons that we've talked about already, What will be of particular interest is their return of cash programs. So they're using their deferred tax assets, which are, and they're looking to redistribute those back to shareholders. And through that, which will result in them distributing more than 100% of their net income, as you can see here. We feel that through the buyback program, they'll raise the net asset value per share. And as the balance sheet gets more efficient, the rating on that net asset value per share will rise from 0.9, where it is at the moment, to maybe 1.3. So that sort of geared effect, outside of all the other drivers for growth in US banks, is particularly attractive to us. So that's it from me. Thanks very much.